Good morning, everybody. Happy Monday. It's April 10th, 2023. Great to be with all of you today. My name is Bob Lang, and I run explosiveoptions.net, along with an amazing chat room with some amazing people. There you see they are right here. Craig and Joel and Christopher and Eric, Leanne, David, et cetera, Brian and Don. A lot of people coming in here. Making some contributions to the room. If you're not in the chat room, come on by and see what we're doing, and so you can learn, make a dent in the market with us. Let's talk about the markets here. I hope everybody had a happy Easter and a really nice long weekend. As we often see in front of a long weekend, we see volatility recede, and it did come down quite a bit on Thursday, and now it's payback time for the VIX. And we see the VIX is climbing a little bit this morning. It's up about 7 to 8%, up $1.46, close to 20%. So, and the VIX futures are up already up over 20. So, we're seeing just a little bit of give back here. And of course, the S&P 500 was up a little bit on Thursday. It was after being down at the beginning of the day, rallied back to close up a little bit. And then on Friday, of course, futures are up strong. After that jobs report, markets were closed on that day. So we're giving it back a little bit here. S&P futures are down, approaching 4,100. The S&P cash, if we open here right now, will open up about 40, looks about 40.80 or so. So below that 40.90 level, which was key level last week to hold. So looking at the board here, we're seeing a little bit of weakness in Apple. We did hear over the weekend that Samsung cut their orders for memory and also said that they're going to have the lowest profits they've had since 2009. Amazon's down a little bit. We did see some strength last week on Thursday on Google. It's giving back a little bit today. Tesla down about $4.50, approaching that $180 level. But what let's talk about some other charts as well too. So. I think that we always have to keep in mind what's happening with the Fed funds futures, right? And I constantly talk about this out on Twitter, out on her daily bites. I talk about it in the Market Blast every single day. And we're seeing now that after last week's jobs number on Friday, which was a strong number, suddenly there's a 66% chance of 25 basis point rate hike coming at the next meeting in early part of May. That's a 2-to-1 chance versus no rate hike versus a pause. All right, and that pause over here, 33%. Now, as you recall, maybe on Tuesday or Wednesday of last week, it was more of a 50-50. So apparently, interest rates started to shoot up again on Friday. The odds of a pause went down sharply, and we see that across the board. In a couple months ahead of us as well too. So this month here, July is an important month here. We see that we're at 49.7% of 475, back to where we are right now. It's actually, if you add these two in there, it's about a 66% implied, 33% chance of keeping those rates above 5%. And this is what the Fed has been telling us, right? They've been telling us that interest rates are going to move up substantially over the next several months and stay there for a substantial period of time. And what do I mean by substantial? I think the Fed is looking, they could pop rates up to 5.5% on the Fed funds rate, and that would be 3 more rate hikes from here. I know the market is not looking at that, but sometimes the market is wrong. And I think we have to pay attention to what the Fed is looking at and what the Fed is saying and what they're doing. It's more important that we do that than pay attention to what the market is telling us right now. So sometimes, again, the market gets it wrong. Look, I mean, we're not here to judge whether it's the right thing to do for the Fed to raise interest rates or to pause. That's not the discussion here. The discussion is, what are they likely to do, and how is it going to affect the markets, and how is it going to affect what we do as traders in the market. That's what matters the most. So I look at a couple of other indicators as well too, and this is one that I bring up from time to time. This is new highs versus new lows. And we can see that in the beginning of the year, certainly in January and February, that was a pretty strong indicator in the bull's corner here. Right now, it's been weakening in March and staying weak in April here. We had the beginning of April had a nice pop in new highs versus new lows, and that's starting to come down again. If we get down to some of these levels in March, minus 200, minus 300, it's going to be up on a sell signal. In fact, if we get a couple of closes below zero in a row, we're going to be on a sell signal on this indicator. The Russell 2000 is one that is an index I've been watching very, very carefully here. It has a lot of housing stocks in there, has a lot of banking names as well too. Regional banks are in the Russell 2000. It has been a weak index for the past month and a half since it broke down below that 20-day moving average in the early part of March. It came straight down. We had almost a double-digit loss in the Russell 2000 in March, but nobody really paid any attention. Nobody was excited about that because they were all excited about the upside in the Nasdaq in the beginning of the year. I get it, but this is a big index. This is 2,000 stocks, and it does lead the markets up or down. We are still below that 20-day moving average. We had a couple of days that we were above it here, but we printed an evening star. This is a calendar chart, a candle chart pattern that I talked about this last week with my students in the training class that we did on Saturday. Evening star pattern is bearish, and it followed through on Wednesday and Thursday. So we got some more downside to go in the Russell 2000. I suspect maybe back down to those October lows. That would be the easy path for the Russell 2000. And if it does make a move down there, it's going to lead the rest of the market down with it as well. The Nasdaq, the S&P 500, and the Dow Industrial. So keep an eye on that. Let's see, what else did I want to show you here? Here's the S&P 500 on a weekly chart. And you can see that it's been having trouble at this trend line up here. And we can see that this dotted upper trend line here has been good resistance right around 4,100. And, again, it is modestly bullish. Don't get me wrong. We do have on the Traders Dynamic Index, which is how relative strength operates with Bollinger Bands. That's on a buy signal. We see at the bottom here, the Stochastics Momentum Index crossed over a couple weeks ago. That is confirmed. That is also on a buy signal. MACD is also crossed over. That is on a buy signal. Again, this is a weekly chart, and we know that these indicators are strong because in the early part of March, the markets were weak, and the last couple weeks of March, the markets were very strong, and it continued through to the start of April. Now, where are we at the beginning of April here on the S&P 500? We've had how many days here of trading? We've had five days of trading in April. I don't think we're up very much at all. We finished March at 4109, and we're at 4105. We have had four trading days. Sorry, so we're basically flat on the S&P 500. Let's see on the Nasdaq. So far in April, we finished at 315. I'm sorry. 320.93, and we're at 318, so we're slightly lower in the first 4 trading days of April. So we do have earnings week starting out this week. We have Delta coming out Thursday morning. We do have several of the banks coming out on Friday: Citigroup, JP Morgan, Wells Fargo, BlackRock, and PNC, along with United Health, which is a Dow Industrial stock, which had a really great week last week. As some of you may recall, last Monday's Daily Bites, when I was in Houston, I called out United Health, and even though it gapped up on Monday over here, it still presented a really, really strong really strong play for us as we bought some 500 calls. I got a doubler on these. I passed on rolling them up. A couple of people in the chat room got on board and added the UNH. I know Shree mentioned it as well too. He was right there. I know Kevin Fullen, who's in our class on Saturday, he mentioned buying the 500 calls and then rolling up to the 510 calls. brilliant move, and now he's sitting back waiting to see what earnings are going to come out to be on Friday. So that's great. And then so I think that the S&P 500 having rallied so much in March. I still think still believe that we're in bear market territory. Okay, that's what we are with the Fed still being so hawkish right here. I get that the markets have rallied back nicely since the start of the year, about 7%, 6.5%, 7%. But with earnings season coming up here, the data is starting to look rather weak. Now, of course, we do have a big week of data coming out. We have the CPI coming out on Wednesday, the PPI coming out on Thursday, retail sales on Friday, the Fed meeting minutes coming out Wednesday afternoon, 2 p.m. Eastern time, along with a few other things like sentiment data, business inventories, industrial production, small business optimism index, and so forth. So a lot of information, a lot of data coming out that's going to skew our view of where the economy is going in the next 3 months. Of course, fourth quarter or second quarter just got underway last week, and then there's we did see that the estimate for first quarter GDP did drop a little bit after the jobs report last week as well too. So would not be surprised to see us give back a bit here. We may get a little bit of restart coming up in a week and a half on the markets, but I do think that with volatility down where it is right now, I do think that we need to exercise a little bit more caution here as well too. So oscillators, let's check in on those right here right now. Plus 34 and plus 85 on the nice oscillator over here. So if we have a let me look here for you. What do we need to turn that negative here? So if we have 1400 differential on the oscillator today, that will turn that 85 to negative or to zero. On the Nasdaq, 710 issues negative versus positive, that will turn that indicator back to zero, and we'll see how it reacts. And again, nice upward slope here from the end of February to the early part of April. A good 5-week run over here, but we got a little bit overheated, and it looks like we could be coming back down for a test of some lower levels. Where are some of those lower levels at? Let's take a look at the S&P 500 one more time over here, and 20-day moving average comes to mind right now, and it's about 39.89 and rising every single day. We finally have the 200-day moving average starting to rise as well too. And 50-day moving average comes in at about 40.28. So these are some significantly lower levels than where the market is currently at, right? 41.05 here, 40.28. That's about 80 handles down. 39.88 would be another 120 handles down, another 3% down or so. So these are some levels that we could get to rather quickly if volatility starts to spike as well too. So just take it slow. Always have some protection on. Remember, bear market playbook. Lots of cash, lots of some protection on. Okay, taking your profits when you have them, and moving on, just surviving to the next day. That's all we're trying to do. Just make it to the next day. Trying to get through Monday here. Let's make it to Tuesday. All right. Have a great trading day, everyone, and I'll see you back on Daily Bites on Thursday.